January 5th, 2024. Something interesting when you get a breakout below a wedge like this. You could argue this is a wedge, three pushes up, and the whole thing was wedge really one, two, three, so it ended up being a wedge double top. But when you get a breakout below, oftentimes the first target is right here, but you can see we kind of blew through it. We ended up retesting it on 33, but we went pretty much right through it. But a lot of times you'll try and get a measured move twice the size of it when you blow right through the initial profit target. And that's about where the low of the day was. So I just thought that was interesting. That happens sometimes on trading range days where you get twice measure move two times the size. I might have some examples. Hold on, I'll see if I can pull them up. I didn't see any good examples, but sometimes you get a measure move twice the opening bar. And yeah, so anyways, bar one, big bull bar closing basically on its high. It's subtle, but it was a failed breakout of yesterday's low. You can see we went to yesterday's low on one and we rejected immediately. Why did it reject? Well, I think a lot of it had to do with the fact that this was essentially a bear channel. If you look on, a wider scale chart, you can see that we've been in a bear channel for about 4 days at this point. We had a bit of an overshoot today, but we've been in a bear channel for essentially 4 days at this point, which is pretty rare. Bear channels usually only last 2, maybe 3 days or 200 bars, depending on what you're looking at. But, we had obviously a smaller channel within the channel, and we got a breakout below the channel. When you get a breakout below the channel, generally there's only about a 25% chance of the breakout succeeding. So 75% chance you have to figure that we were going to test back up, and 75 or 70% chance that we're going to test the opposite side of the channel within like 5 to 10 bars. So when you started to get this at the end of the day, you started to figure, it was possible that this was going to be a failed breakout below the channel. It was actually likely. And then on one, you can see bears try to get a breakout and confirm the breakout below the channel, and it got rejected, and big bull bar on one. So I think one is probably actually a credible swing buy. But the problem is if you're going to buy above one, you have to be expecting disappointing follow through since this move was relatively tight. So you can't really exit below two, I don't think, if you buy above one. But disappointing follow through for the bulls who bought above one on two, but that's kind of expected, testing the other side of the channel. And two is essentially a low two short, low one, pullback, low two. But I don't think it's a very good sell. We're deep in a bear channel and we just got a failed breakout, so it's really not that good. Disappointing follow through on three disappointing follow through 4-2 during three. Three is a double bottom with one. Do you buy above three? I don't think so. Big tail on the top just looks like a tight trading range. Follow through for the bulls on four, but you didn't break above the neckline of the double bottom. So the double bottom 1-3 had a neckline of the high of two. The neckline of the double bottom is always the highest price in between the 2 points. And you can see we were not able to get a breakout above it on four. So four is not all that great of a buy. Disappointing follow through on five, a doji bar. Do you exit? I think a lot of the traders who bought four, they knew they were taking a pretty big risk. If you bought above four, you basically wanted to see another good bull bar like four, and you don't get it on five. So you can see, look at one tick above four is their entry price, disappointed five, and they're trying to get out of break even during six, and that's causing a lot of the selling. It's 2 legs up, so it's essentially a low two and a double top with two below five, but it's a doji bar and it's a higher high, so you probably need a lower high. And just the bulls are getting better closes than the bears so far today, so I don't think it's all that good. Seven, obviously a large bull surprise. And, just like yesterday, actually, I mentioned that when you get a bull surprise, and a lot of times traders are going to look for this measured move up. And I talked about the pullback, but the same thing here. Traders are going to look for this measured move up. We obviously got a lot closer to it today on the first bar than we did yesterday. Something that's interesting is the market a lot of times will do something a couple of days in a row. So, it'll do this thing, or it's essentially form a low two, break out above the low two with a big bull surprise. Form a low two, break out above the low two with a big bull surprise. A lot of times, especially in the open, it'll repeat a pattern like, within once or twice within a week, and then it'll switch to a different pattern the next week. So, the logic for it could be, traders see it happening once and they start to see it happen a second time and they trade it. And then the third time, if it tries to happen again, it fails because everyone sees it. And so there's not a lot of traders willing to take the other side. And so it just doesn't end up happening. But big surprise on 8, follow through for the bulls on 9. It's not the best, big surprise on 7, follow through for the bulls on 8. Is it the best buy in the world above 8? No, but it's definitely reasonable. If you're buying above 8, you have to realize you're going to sit through a pullback. If you buy above 8, you're signing up for 9. So, I think that if you bought above 8, you don't want to exit below 9. If anything, you want to be looking to buy more. And what is a logical target, right? The 50% pullback. So let's say you bought above 8, and you're going to want to buy more at a 50% pullback. And that's exactly where 10 went to. So traders weren't really selling below 9. It was just there was a lack of buyers because everyone was waiting to buy the 50% pullback. When you get a big spike, traders often look to buy the 50% pullback. I don't think we quite got to 50% yesterday. I suppose if you use the top of that, we got exactly to it as well. So, in general, when you get these big spikes, the risk is really large. So traders don't like to buy at the high of the spikes. They like to buy pullbacks at the spikes, knowing that this is strong enough for a second leg up. And they're expecting the second leg up to essentially be, they're expecting the second leg up to essentially test back to this close, at least. 12 or 11, a big bull bar, but not all that great. It's interesting if you bought, say you bought the close of this, or bought, let's say, above 8, right? Basically one of the highest prices you could buy. You bought more at the 50% pullback. You're basically right around your break even at the close of bar 11. So buying above 11 is probably not all that great because you're going to have traders who bought above 8, disappointed 9, 10, trying to get it around break even during 11 when they scale in. So that's probably one of the reasons there were sellers there. 12, not a very good sell. It's a low 1. You could argue bear's argument is this is the start of a bear trend. 11 is the pullback in their bear trend, and 12 is the lower high. But this is really 10 through 12 is just a tight trading range. And if you're selling 12, it seems like you're selling low in a tight trading range. Big outside up 13, so good bar for the bulls. Not quite closing near its high, so not as good as it could be. But notable that once you get this bar, I think it's okay to put your stop below here because realistically, if we get below here, it's really not all that good. Generally you would want to wait till you break to a new high. But once you get this second reversal up, if we break below the second reversal up, you want to reevaluate what you're doing. 14, a bear bar. You could argue it's a second reversal down. It's a low 2. So, bear trend, bear breakout, low 1, pullback, low 2. But there's something you kind of got to look at the context of the whole day when you're looking at 14. What have bears done today that's been impressive? Pretty much nothing, right? Bear stop orders haven't really made any money so far today. Nothing has really gone far enough down for the bears to even make a scalp. And if you're selling 14, you're selling right in the middle of a tight trading range. So it's really not all that good. And if you're selling 14, you're also, you're selling right after a bull bar. And look at all the bull closes so far today. So just think about it. Look at the bear closes today. Big tail on the bottom, big tail on the bottom, decently big bars, but big tails on the bottom. Big tail on the top and not a great close. And then look at the bull closes today, closing near its high, closing near its high, huge, and closing near its high, closing somewhat near its high, closing near its high, closing near its high. So the bulls are just getting much better bars so far today than the bears are. And additionally, bull stop orders are making money. I mean, you could have bought anywhere in here on a stop above any of these bars or any of these breakup points, and you would have made, really good money. And you could have bought above this, and you would have ended up making, maybe a scalp. But my point being, bulls were making a lot of money so far today, and bears really weren't making any money, and bulls were getting much better closes. So I don't think it makes a lot of sense to sell below 14. Outside up for the bulls on 15, another good bull close and disappointing follow through. It's notable that the bull stop orders are getting disappointing follow through consistently, which means this is probably a trading range, and we're trying to form some sort of wedge double top here. The bulls end up wanting to break out above the wedge on 21. But it doesn't close very strong, and so you end up getting a failed breakout 22. But I'll get there. So was it 15? 16, essentially 3 pushes up, but not a very strong close, not all that good. And I think 17 was the last chance for the bulls. They continuously got disappointing follow through, and now you're getting towards the top of the trading range, so it's tricky to be long if we end up getting more disappointing follow through. Which you get more disappointing follow through on 18, and then a bear bar closing near its low on 19. It's a double top with 9, and you could argue it's essentially a failed breakout of the 18 bar range. So a lot of traders will exit below 19. But do you sell below 19? It's probably a scalp at best. Is the problem. Bear stop orders haven't really made money yet today, so you don't really ever want to try and be the very first trader to make money doing something. So 20, that's why there's a big tail on the bottom, because traders were scalping. 21 bulls, if you sold below 19 and you see 20, you just got to pretty much get out of the market, and that's what's happening on 21. And then 22 is a failed breakout of the 18 bar range and a big surprise in the other direction. So you can probably sell 22. You can see it's first off, it's a big surprise, so it's good enough for a second leg. And whenever you get a failed breakout of the 18 bar range and a reversal within a couple of bars, traders will try to get a move in the other direction. Did I already put this in here? Yeah, I did. So we'll just look at a couple of these examples. 18 bar range, failed breakout of the 18 bar range, bear starts selling, bear closes, you get a reversal down. Failed breakout of the 18 bar range, reversal down, but the reversal fails. Failed breakout of the 18 bar range here and a higher low major trend reversal. I think that was today. Yeah, and one or two more. This wasn't as good, but yeah, well, actually it was. 18 bar range here, failed breakout above the 18 bar range and 36 bar range, you get a big reversal down. So you can see that a lot of times traders, when you get that failed breakout, they're going to look to sell. And, that's exactly what happens here on 22. You get the failed breakout of the 18 bar range and a reasonable sell below 22. Follow through on 23, but not a like rate. What's the target, right? So yesterday I talked about open gaps, how we had this open gap. And, you can take the sell below here looking to close this gap. You can take the sell below here looking to close this gap, right? So what's the target today? Well, where's the open gap? It's right here. So I think selling below 22, it's only a scalp target, initial target, but it's a logical place to take some profits. And, you make more than 5 points. So I think it's okay. But if you sell below 22, you get bad follow through 23, kind of expected after such a big bar, 22. 24, follow through for the bears. It's always in short. Disappointing bar on 25, but a tight bear channel. 26, tail on the bottom, but still a tight bear channel. More follow through for the bears on 27. Okay to sell below any of these bars. Okay to sell closes. Again, we're in a tight bear channel, you can see. So, I think we're going here. And you can see exactly on 28, where did we go? We went exactly to that high, that 5 high, because so that those limit order bears were let out at break even. And they bought back their shorts, and that's what caused the pullback on 29. So bears buying back shorts, that causes 29. 30, essentially, low one below 29. It's still a tight bear channel, so you can still sell any of these closes and just get out above a good bull bar. And then you can see we get another bear bar, 31. And we end up getting a breakout below the whole wedge. So you're looking for maybe a measure move down to here, which is we ended up getting. But you get spike, and then a channel, and then a breakout below the channel. It's lower probability that you're going to get a breakout in general, but with the context of the day being probably a trading range, it was reasonable to think we were going to get to the open, which is essentially what we got vacuumed to on 32. 32 is such a huge bar that there's going to be some profit taking, so you can't be that surprised when you see 33. 34, low one short. If you're short, do you sell? If you're short for any reason, do you buy back your shorts above 33? It's kind of a tough call with the tail on the top. It's not as good as it could be. But clearly, if you sold this close, this isn't what you wanted to see. I think that 32 is more of a profit-taking bar because it's around the open of the day on a trading range day. 34, do you sell below 34? I think it's okay to sell below 34. It's a low one short. But, it's clearly always in short. So any traders who do exit above 33 are probably selling again below 34. But it's just generally difficult to want to sell this low. Follow through 35, 36, 37, but you can see big tail 35, big tail 36. And then what did 37 do? It tried to break out below the low of the day and failed. And traders bought back their shorts, causing 38. So we now have a failed breakout of the low of the day on what is probably a trading range day. Not all that great. 39, bull bar, but not the best close in the world. And the thing is, you get 38 up, down on 38, up on 39, right? So one pullback, two. 39 could be a second leg. 39 could be a second leg trap. So this could be 2 legs up, and you could sell below 40. It's a low one short. It's a double top with 34, but I think if you sell below 40, your stop is above 34. That's why, 41 runs poor stops. Traders who place their stops above 40 were punished rather than putting their stop above 34. If you sell below 42, you can sell below 42. It's a low 2 short. Any of those traders who got trapped out here, going to look to sell again here. If you're always in, you can sell again. I think a lot of traders might sit it out, though, because it's so low in the trading range. It's just concerning to sell this low. But it's strong enough that it's okay to be short. Follow through on 43. Traders get a quick 5 points and start to scalp. That causes 44, but 42, 43, strong enough, probably going to get a second leg, which they do, 45, 46. And you can see we got a breakout of the day's low, and then we retested it, and they tried to get follow through, but they just weren't able to get it. And then you get a huge bull bar, 47. It's probably some sort of wedge. It probably doesn't really look like it. I would argue though, it's more like, well, first off, it's spike, channel, and then it should be trading range. But then you get another spike. So then it's spike, channel, expecting trading range. And you're really low on what is probably a trading range day. So I think the important thing to ask yourself when you're looking at 47 is, do you think it's a trading range day or a bear trend day? And I think with 7 and 8, it's really tough to make the argument. And a couple of failed breakouts below the low of the day. It's pretty hard to make the argument that it's a bear trend day, especially after seeing 47. So a lot of traders are going to exit above 40. Bears are going to exit above 47, and bulls, knowing it's probably a trading range day, can buy above 47. What's the target? Well, the top of the channel is the first target, which was reached almost immediately on 48. And what's the second target? The second target is the top of the most recent sell climax, right? So you could argue that it's 32, top of the most recent sell climax. I think that's reasonable. But you could also argue that the sell climax started up here on 30, and that's where we tested on 57. So big bull surprise 48. More fall through 49, but a tail on the top. More fall through 50, but you're getting pretty high up now. But this is a strong surprise, so it should be good enough for a second leg up. Bear bar 51, but doesn't trade below 52. You can see the traders who bought the close of 50 disappointed 51, getting out around break even during 52. 53 triggers below 52. Inside bar 52, so triangle. 54, another inside bar. Are you going to sell below 54? Probably not. Bull traders exit? Maybe. So that's why you end up getting bulls buying the close, causing 55. But bad follow through 56, traders selling the high rather than buy it, which is a problem for any of the bulls who are buying up here, hoping we were going to get a big second leg and maybe get back to this 21 low. Why the 21 low? Because bulls bought below 21 since it was a bull bar and they got trapped the whole way. 57, doji bar. Do you exit below 57? You can probably exit a point below 57. If you bought anywhere up here, your premise was this was going to be a good bull trend or some sort of bull channel. And it's really not looking like that. And when you get this bar, think about if we trade down here, it's just looking like a tight trading range. And that's why you get 58, because traders are exiting. 59, a bull bar, but not all that great. Not closing very strong. Bulls hoping that this is a bear trap and they're going to get another leg up, but unlikely with how bad that closed. 60, essentially a low one short, so spike, pullback, and it's an inside pattern. So 59.60, but probably going to wait for the breakout rather than sell. You get 61, bad follow through the traders still below 60, failed breakout above the II on 61 on 62 and a reversal down. Okay, sell below 62, probably looking for something like this, which might be around 2-to-1 of your risk reward. What do you know? 2-to-1 of your risk reward, same as the spike. None of that is random, by the way. That's all algorithms placing that stuff there. Follow through 63, 64. 63, okay to sell the close probably. Probably going at least a little bit lower. But if you get a bull bar, you got to get out. Follow through 64, follow through 65. And 65 is the most climactic, the biggest, best looking bar. So probably climactic towards the bottom of a trading range. And you can see it was essentially just a vacuum test of the 46 close. 67, inside bar. We're low in a trading range, so probably best to get out above anything or just at the market. And traders getting out causing 68. Rally on 69, but probably going to get a second leg down from this. And you can see we essentially tried to get another breakout below the low of the day, but we failed 72, 73. And then traders started buying back shorts causing 74, 75. I would just let this go because it's too late in the day. For stop orders today, I didn't think there's anything great in here. If you're, feeling really risky, you can sell below 19, but I would just get out when you see 20. Or if you sell below 19 with a wide stop, 22 is probably a good stop order. 24, sell the close 26, 27, anything through there for always in. Maybe you can theoretically sell this close, but you're pretty low in what's probably a trading range. You could buy above 47 or 48, 62. And yeah, that's basically it. On the daily chart, we're getting, we're at the moving average, and this was such a strong bull move. I don't even have the whole thing on the screen. It's such a strong bull move that we're probably going to end up getting a rally. How high? I'm not so sure. This will probably form a lower high, and then we'll go sideways. It'll at least try to form a lower high. Let's put it that way. I'm not sure it'll be successful, but the bears will try to form a lower high. I don't think we're going to rally straight up. This is a pretty tight bear channel, so that's why I think that we might get a lower high. But these closes aren't that good, right? There's a huge tail here. There's a huge tail here, a small bull bar. So this is really not excellent for the bears. So I don't see, I don't see us going down that much further. I think we're going to bounce over the next couple of days. On the weekly chart, the bears finally got a bear close after so many bull bars. But after this many straight bull bars and strong ones, bulls are going to buy the first bear close. So this is likely to get bought up. And yeah, that is the day.